Okay, so thank you all for being here. I did just want to mention, the original goal of this group, or not goal, but limit was I didn't want it to be more than 16 people because of dining restrictions in Columbus to get a free private room. Since nobody dines together anymore, I kind of thought that wasn't as important. But also, there's a couple out of towners that I've added that even if we are able to ever get together in the same place, we won't invite them, so they won't cause us any problems. So I did add a couple of people. I'm excited. I know one of them, Ryan, has a considerable amount of experience, so that'll be great for our group. And then Jeff is kind of similar to Sean in that he's raring to go and is intending on investing in several syndications this year. So I think they're going to be a great addition to this group. And so I'll have them introduce themselves in a minute, but I did have a couple of things I want to talk about. First, the first thing is this book. Is that coming backwards to you guys?
Oh,
no, it's good.
Good.
Just to me, okay. Well, it's a great book. I finally read it. It's Brian Burke. It's a hands-off investor. I think Steve, have you read it yet? I know you ordered it.
Yeah, I've read several parts of it, and I've on Amazon. There's probably about 4 or 5 of those kinds of books, and that's probably the best one.
Okay. Yeah, I tell you, I have about 8 books that I'm reading right now, and I get through chapter 1, and then I just stall out. This one, I read in 3 or 4 days, and I haven't taken notes on a book since college, but, I have notes that I actually took on this thing, which makes me feel like a nerd, but it also, there's some really good stuff in that. So if you are serious about doing this passive investing thing, whether you've started already or not, I would absolutely recommend that book. It's money well spent. It's an easy read, and it goes through some of how to analyze a deal and how to look through the PPM and how to, even analyze the balance sheet. And it's just really good. And we're going to use some of that for the spreadsheet we're trying to come up with. And that's another thing. So no one feels excluded. We started a little mini group within our group to try to work on getting a spreadsheet that has all the sponsor questions we like and all of the deal type questions we like. So Sean, Steve, and oh my God,
Mike.
Sorry, Mike Rodriguez. Since he's not here, I forgot all about him. The 4 of us are gonna get together for a Zoom call just to see if we can iron out some of the things that we want to have in that spreadsheet because. We're the ones that have kind of done some deals already and have some ideas on that. So that's not something we're trying to exclude the group from. It's just something we think if we get a small group can iron some stuff out and then we'll share it with the larger group. So we're gonna meet on that Thursday. If anyone's dying to be part of that, just let me know and I'll add you in. Like I said, we're not trying to exclude anybody. We just want to try to see how far we can get this, and we've had some side conversations already. So if you're super into it, let me know and we'll add you in. The last thing is one goal I'd like to see if we can have for the next meeting, definitely for those that haven't done it yet, is see if you can get one sponsor call in under your belt. Like somebody, if you haven't done it yet, it's such a good thing to do. Since our last meeting, has anyone called anybody, like had a call with a sponsor?
I spoke with Travis, who was the speaker at our last meeting.
Anybody else talk to Travis?
I did.
Yeah, I did the same.
Oh, awesome. Okay. That's on the agenda. I had my name and a question mark because I wasn't sure who done it. So I think when we get to that point, we should all kind of summarize our conversations and see what we got out of it. Because I thought it was pretty interesting to talk to him again. So Travis, did anybody talk to anybody but Travis? No? Okay. Well, it seems like everyone's doing that. So I would just recommend that if you haven't done that yet, or even if you have, if you could add another one, and then let me know, and we'll include these in our calls, because most of what today is going over some of those. But
hey, Jim.
Yeah.
Or really anybody. Anyone else have like another person that you'd recommend talking to? Just like Travis was amazing, and I would give him a call. But if we've all talked to him, just to get a different person out there, is there anyone else that we've kicked around or that I should consider?
I called Praxis Capital. It's the guy that wrote this book. I didn't get to talk to actually Brian Burke. I talked to another guy. He was super informative. The minimums on their group is a little bit bigger, and I'll talk about them later. But that's a good one. And then there's a list that I have here with just some. If you want to, I don't know if you're looking to talk to someone that someone's already talked to, or if you want to do a brand new one.
I just saw that we all raised our hand for the same person, so I figured I'd just call the next. That was the only guy on my list because he's the one we met last week.
Try Dan Hanford from PassiveInvesting.com. He was a really good one too.
Okay.
And then if anybody else needs ideas, I think it'd be great if we get some new ones. But I think talking to the same ones as other people have, it gives us a different perspective. So, that's good.
I've got Dan on my list as well. I did his online setup, and they reached out to me to set up an appointment. So I'll have a conversation with them hopefully, and then this week probably.
Okay.
Another round to go through with Dan.
And then if someone wants to do it, I haven't done it yet, is the Big Mike Fund. It's a fund which Travis was against, but then once I talked to Travis, it turns out he's investing in quite a few funds. But Big Mike Fund is one I've been thinking about calling, and I just haven't gotten around to it. I've heard him on a couple of podcasts, and he's entertaining. So it'd be a fun conversation if nothing else. But just look, I think if you're looking to do one, just maybe try Google or some of the podcasts you listen to, and just try a random person, just so we get some outside of our normal, who I'm dealing with. Try and maybe look it up and see if you can find someone we've never heard of. All right. So at this point, I just want to introduce again, Jeff and Ryan. If you guys could take, 30 seconds to 2 minutes and just kind of say where you live, what you do, and what kind of passive investing you're doing or what your interest in it is. And Jeff, you want to go first?
Sure. Hi, everyone. My name is Jeff Geegan. I live out in the Boulder, Colorado area. I just moved out here 6 months ago from Cleveland. And I know Jim and Annette through a smaller real estate investing group that we're a part of. So thanks for the invite, Jim. My background in real estate's really small. I've done a handful of duplexes in the past, but nothing that's, made a ton of money. And it was honestly kind of painful. So the idea of more passive real estate has always piqued my interest. And I've kind of researched syndications in the past, but always had two major concerns. How do you analyze those deals, and how do you trust the sponsors that are making those deals? So I was telling Jim about my interest in doing bigger deals this year and next, and syndications were a big part of that. So definitely have a lot of learning to do, and excited to be a part of the group. For my full-time job, I'm an outside sales rep for Mayo Clinic, the hospital, and I do laboratory sales for them. So nice to meet everybody.
Cool. Thanks, Jeff. All right, Ryan.
All right. My name is Ryan. I'm from Billings, Montana, and I think, as Jim mentioned, he and I met through Buck Joffrey, for those of you that are familiar with him, at a meetup last year. I've kind of started passive investing for quite a while, mostly started with turnkey rental properties. So I have six properties with 10 doors, so a couple duplexes and a triplex in there. And I've kind of got shiny object syndrome. I've bounced across a ton of different things over the last, I've probably been doing passive investing for 4 or 5 years now. So started with rentals. I'm looking down at the list that Jim has on his agenda. I'm probably in 10 or so syndications, all at minimums. I like to try and diversify across kind of a different portfolio of different things. So I'm in some mostly multifamily real estate syndications. I've got some oil and gas and life settlements and online stuff through Fundrise, cash value life insurance. I mean, I've kind of tried the gamut of things, but one thing I think I've found is that it's really the provider, kind of what you guys are talking about tonight. It's really the provider and the sponsor that you really got to get behind. I've had, and I'm not speaking across the platform, but I've had an experience in Equity Multiple, if you guys are familiar in there with some of their stuff. Just no transparency. We're not operating at pro forma at all. So I would really stress what you guys are looking at right now. Get to know your sponsor. Trust the sponsor before the deal. Don't get carried away with the deal. It's kind of bit me a couple times too. So I'm happy to get the invitation here to join you guys when I can, and get kicked out when you're local, when you're going to the restaurants there locally. So I'm not a big detail guy, so I'm not the type that's going to research forever and ever. I go till I feel comfortable, and then go with that. So happy to give any insight I have, but that's kind of where I'm at for today.
Awesome. Thanks, Ryan. You know, Ryan and I have been, we're also investing together. We did Annette's not here today to talk about TribeVest, and we'll postpone that for another one. But, you know, TribeVest is the platform that makes it easy to invest together. And Ryan and I talked a lot about the Western Wealth, which we've talked about here, Buck Joffrey's group. You know, and he, before, you know, pre-COVID, he was doing, you know, at least a deal a month, it felt like. And they're all $25,000 minimums. And Ryan and I were talking about, you know, yeah, we'd like to be in every one, because $25,000 for 12 times a year is a bit more than we could handle. And so we were skipping out on ones, and which do you skip out on, and all that. So we got a group together, 5 of us. It's his family members, 4 of them, and me. And we just committed to doing every single Buck Joffrey deal that came across the desk this year in our groups. And so now we're throwing in $5,000 a deal. And we did a few, and then, you know, COVID. So hopefully we'll get rolling towards the second half of the year. But, you know, that's one of the things that I think might happen in this group, is we might have some people who decide they want to, you know, go in together and invest together. And you know, I think that's a great thing if that happens. I'm not trying to encourage that or discourage it. It's just what Ryan and I did, where we kind of had our own, you know, for a while there, we were calling each other every couple of weeks, just kind of talking about deals and talking about how we're doing stuff. And similar to when I started talking to Steve, it was just really encouraging to find somebody who was doing some of the same stuff I was, had the same ideas. And that's why I really love this group, is because now we're having more and more people that are going to have similar experiences, and we can just kind of grow together. So I'm super excited about that. And I'm glad Jeff and Ryan have agreed to come on board. So thanks, guys. Appreciate that.
Hey, Jim.
Yeah.
So when you're doing that and you're all putting in the 5,000, are you forming an LLC and you're just capitalizing it and then investing with that?
Yeah. So the reason we did TribeVest is really just the platform, and it allows you to put money in separate bank accounts until you form the LLC, and then they do the LLC for you. And it just makes it easier. You could do it without TribeVest, certainly. And we didn't even need the bank part of it initially, because we weren't saving up. A lot of TribeVest, like the smaller group I'm in, that Jeff is a part of and Annette's a part of, is we're saving cash, putting it in there, and then once we get enough, we're going to form the LLC and go forward. But yes, we have an LLC, and that just, you know, we kind of toyed with, well, how do we do this? Are we going to do it for a year or more? And the LLC is going to last until the last deal pays us back. So that's one thing I've really been thinking about lately too, is, you know, these are the syndications. One thing they're probably the least liquid investment you can have, because Ryan was talking about his single family homes and the doors he has, and I have some of those as well. But if something really went bad and I needed cash, I could sell those, maybe at a discount, but I could sell them. You're not selling out of a syndication. And if you have it in an LLC with another group of people, that just makes it even a bigger commitment long term, where, you know, it's just not liquid. But that's why I felt comfortable, because I feel comfortable with Ryan, and then he threw in family members, which just made it easy. But yeah, that was a long way to answer yes, LLC.
Thanks.
Yeah. Any other questions? All right. So next on the agenda, we're going to skip past Annette and go on with Jameson. And I asked Jameson to talk a little bit about life insurance. That's part of what he does. He's a financial advisor, so he does some life insurance. He does some for me. I used to sell it myself. But now I have Jameson manage it, and it's just another way to create another asset that you can use to kind of create a separate asset and to do some real estate with. And so Jameson's going to kind of give a little intro about how it works, and then anybody here who has experience, I know Ryan does, I think Steve does, maybe we can, Jameson, you can ask them to kind of say what they've done with it, if anything.
I should probably unmute myself. Yeah, no, that'd be great. That was a perfect intro. I know, Ryan, nice to meet you. Welcome to the group. I know you mentioned something about life insurance, so maybe I'll go through a couple things, but if you don't mind, I'd love to hear your experience. Steve, I think you had mentioned having some experience. So yeah, maybe give me a little wave if, besides Steve and Ryan, anyone else with, yeah, Brian, right, yeah, okay. All right, cool. Well, I'll hit on some things, and then I'd love for you guys to share maybe the experience with your group. But so one of my pet peeves, if you know me, is I hate when people think up clever marketing names for something that's just been around or just is a certain thing. So like Jim gave me his book on the EQRP, and I was sitting there reading this thing, so annoyed by it, because everything I read, I'm like, this is just a self-directed 401k, but I had never heard of that before. I knew self-directed IRAs. I know solo and individual 401ks and regular 401ks. I know all the numbers. I just hadn't really heard of a self-directed 401k before. So I was sitting there confused. And then eventually, I don't know if it was by the end of the book or if I did a little more research, I was like, okay, now I understand. So I don't like marketing names. Infinite banking even bothers me a little bit. There's a guy in my office who sells life insurance policies. That's all he does. And he calls them unlimited Roth IRAs because there's no limit to what you can put in them. And it's got similar tax treatment. Jim can tell you that bugs the hell out of me. And it's actually unethical and not compliant, but he'll say it over the phone. He won't put it in an email. So cash life insurance contract, that's what I think the best term is. And so those are my speaking points: cash life insurance contract. So the main reason why people try a strategy like this, like some of you have, typically it's about the cash. So you need cash or capital when you're making an investment or buying a piece of real estate. Many of you have probably run into the issue. You started buying real estate and you get to a point where you go to get a loan for your next property and you're not really lendable anymore. So the first part about the cash, I think that's good to stress. I might have some company here in a minute, little kids. It's not an investment, right? So it is cash, just like that's the easiest way to think about it's like a bank account. It's accessible. You can get it when you want it or when you need it. Also similar to cash is it's backed and secured. The balance is secured by large general reserves in the company, just like a bank, except the requirements on reserves are 100 times as much. And usually it's backed by a state guarantee association instead of the FDIC. So there's some security in your cash. It's not an investment, so that you don't have market fluctuation. You can structure in market fluctuation, but that's maybe a different story. So when I say can or may, or I give some disclaimer, usually it just matters how you structure it. So, the other thing I guess is there's no penalties if you want to access it. And there's no applications. Like I had a meeting right before this and we were talking about, they're trying to decide if they wanted to refinance or they had some extra money. Should they pay off their mortgage or should they just like save it or something? And I was like, well, if you put in the mortgage, how do you get it back out if you need it? And they're like, well, I guess we have to ask the bank if they'll let us apply for a refinance. Yeah. So getting your money back is important. So so that's just the first point, right? Cash, life insurance. So what I find a lot of times the most underrated part of a life insurance strategy is the death benefit. So when you do a contract like this, or the way you guys probably have yours structured if you have one, It's structured to produce more cash, which is good, but the death benefit is also its own asset. So, Ryan, you mentioned settlements. We talked about life settlements before. The death benefit is something that can be collateralized. It can be sold. You could structure a policy just for death benefit, but a cash policy is going to be some combination of both. You can have focus on the cash and make the death benefit basically irrelevant, or you can do it the other way. But and then so I guess the other part that is important, I forgot I put it under this section, but tax treatment. So life insurance by definition has certain tax treatments. Some of you might know this, if you put too much money in to the policy, more than what you're allowed to put in, it becomes what's called a modified endowment contract. It will look and feel and sound just like life insurance, except none of the tax benefits apply. It's also illiquid now. So all that to say, it's section 7702, 72, and 79, I think. I don't know. But basically, those sections in the IRS tax code say that it grows tax-free, you can spend it tax-free, and then you can transfer it tax-free. So it's back to my point earlier, it has a feel of a Roth IRA from tax treatment, but there's really no limit on how much you can contribute when you're setting up the plan. And then finally, I just like to point out it's a contract. So when you get a cash life insurance policy or a contract, you have a document that you own, and that document spells out stipulations. The main stipulation for you as the policyholder is that you're going to put a certain amount of funding into this policy over a certain amount of time. So that gets determined up front, but after that point, all the other stipulations really are on the insurance company that you use. And it's their obligation to fulfill all the requirements from, your responsibilities on page 1 with what you're funding and how you're funding. Page 2 through 100, that's about the insurance company, what their responsibilities are. So I just like to remind people of that you've got this great cash asset, and I'm hopefully those are some of you guys can share, or I know Jim can share how he's used some of the cash in his policy. But there are these other components that also can have value. If nothing else, the death benefit and how you can, like a settlement would be an example, but how you can spend it on yourself. I guess if I'm doing a talk, I usually ask that question, like a true or false. The death benefit can't be used or accessed until you die. Well, as Ryan knows and Jim knows, a settlement is a way to use your life insurance death benefit to get some cash or some money back from it while you're still alive. So, and there's some other ways to do that too. But so let me open it up for questions, I guess. And then I would also love to hear just how some people probably have different companies, different policies. I'd like to hear the experience. I actually, and then someone else can start talking, but I had a client. He is he was sort of like when I first went into business, he was like the first real estate person. He was successful even at this point that I talked to. And normally I don't pitch ideas. I try to get clients that want financial planning. But I knew he didn't want that. So I just was like, well, here's a cool idea, like life insurance. He's like, nah, I don't think so. No, thanks. 2 years later, he called me, 2 or 3, I don't know. And he's like, yeah, I'm talking with like my Northwestern Mutual person, and they're showing me this thing. It kind of reminds me of what we talked about. So long story short, we ended up putting a bunch of policies in place, but I could always tell he was a little like not sure it was a good idea, but he did it anyway. So it's like, okay. So he finally, like last month, he had a deal that he was in on, and he has enough properties at this point. Like he's expressed to me, he sees a lot of good deals. He's really only looking for great deals. So when he finds a deal, like it has to happen. And he was about $20,000 short. And then he remembered his life insurance policy. So I think he called me Friday. And I think his checking account was funded on Monday, which is faster than it's supposed to be. So no one call me for policies that fast. But we got an exception and got him the money he needed by the time he was closing. So anyways, he had another policy though. I had another client call for the same thing. Their policy was with a company that's just not good. It's not a good company to be with. He asked for money. It's going to take 30 days for the funds to get to him, and it has to come by a paper check.
Pony Express.
Yeah. I was pissed, but I felt bad for him too. But so anyways, you could have a wide array of experiences, especially if your contract was, as Jim likes to put it this way, I think it's good too, but if the contract is structured for the commissions for the agent, you'll have a different experience than if it's structured to create cash value for you. So anyways, questions, or if anyone wants to share about their own experience, I'd love to hear it.
Yeah, Jameson, how do you identify which policy is benefiting the agent versus,
Yeah, good question. So it's not you can't tell by looking at the policy alone. You really have to match up the policy with the policy holder and what their goals are. So most, it's like there's this trade-off. So I can fund a policy to be more beneficial for death benefit or more beneficial for cash. And I think the average person, like when I design a policy for like an average person who I hope someday they explore real estate, but they have no plans at this time, then I'm going to structure it a little bit more for death benefit, because that death benefit could be part of our long-term care planning, a whole bunch of other things. So I kind of do a balance probably most of the time. But if I'm talking with someone who's like, I want to use this policy to buy as many properties as I can, or like one young guy, he was real young at the time, and I think we set it up to buy one property a year for the next 30 years. Something like that. So the illustration showed that. So the main way you know is you look at the original illustration to see what you were sold versus what you actually bought. So I would actually look at it and I would ask you questions. Based on your answers and what I'm looking at, then I would know which one you got.
Let me add to that, Jameson, for Mike. I think as he was talking, I can think of three ways to figure out if you got the right person, right? Someone who's in it for commission, because these agents are incentivized to do what's right for the client, but also to get the highest commission, right? So it's very difficult. The number one way is to find an agent that you trust, and really the way to do that, I think, is find someone else who's had a good experience and get a recommendation. But even then, you can't be sure, because the person you're getting a recommendation from might not know what the best policy is. So a good way, I think, would be to interview a couple of different agents, so you're getting a couple of different opinions, but also to say, look, I'm a real estate investor and I want life insurance. What do you recommend? And or start the other way, say, what do you recommend if I need life insurance? And then say, but I'm a real estate guy and I need cash, and see if they give you the same answer or if they come up with a different plan. Because I mean, the first person that sold me life insurance was me, and I sold myself the wrong policy. And so now that I know what I want it for, and I know that I'm into real estate, I've sold myself the right policy, and Jameson sold me the right policy. So there is a,
as far as you know.
Yeah, as far as I know. Exactly. So I think you got to maybe go visit with a couple of people, and maybe at least have one of them be from someone that you trust, that you got a recommendation from, and then make the agent prove himself or herself by saying, okay, here's, what would you recommend for me? And then say, and also I'm a real estate guy, and if they don't change their tactics or say something about that, or have an intelligent, well, you're real estate, so you probably want more cash and we need to set it up differently. It's hard. It's a really hard thing, but if you can find someone who knows what they're doing and they are thinking of you, and making sure they're doing the right thing for you, then that agent knows that it'll pay off for them in the long run. So you need someone who's in it for the long term, and not just someone who's going to be in it for like 3 or 4 years, like I was. I don't know if that helps or not, but that's kind of what I was thinking when you asked that question.
Yeah, it does. And
Good
so
point.
basically in summary, so if you have more access to the cash that you're committing to. So if you wanted to put 50K toward the policy and whatever, I don't know what the numbers are, 40 of it's available the first year, that would probably be a policy that's more applicable to what we're trying to do if we're trying to free up cash, right?
Yeah, especially like in the first year.
Yeah.
Absolutely.
A straight like whole life policy would have nothing available the first year.
Sure.
But the other
So-
thing is, sorry, but your policy, you can't, I always try to design a policy that would do everything, right? I got kids, so I want death benefit. I want to retire, so I want cash value. I want to pay for their college. And I want to fund 3 real estate deals this year. Well, one policy is not going to do all that. And once I'm like, okay, I'll accept it. I might need 2 different policies, or I might need to do something, I might need to give up this one thing to do this other thing. I think that's also, you can't hit all your goals. You got little kids, so you're going to need one that's a death benefit, right? That is focused on that. You want to develop a secondary asset for maybe investing some of this cash into real estate. Well, you might need a policy for that, and they might not be the same policy. Now, there might be parts that work together that you could do the same policy, but they're not all going to, you might have to have a couple different strategies. So you got to be
Jim,
open to that.
I would just tweak what you said to say it won't do it all. I would just say that you have to prioritize, because it does do it all. It just will, but it's going to do one thing better than another, and you get to decide what that thing is.
Gotcha.
Good point.
Yeah, because I was thinking even because I just did a policy. This was the first year, but I was thinking it was a pretty healthy death benefit, even though I leveraged it for cash. I mean, it was like, I want to say like $1.9 million death benefit. Now, I think if you pull that cash out, right, Jameson, then your death benefit goes down as soon as you're leveraging that cash. But if you have cash in, it can be pretty sizable, even if it's leveraged for cash.
Yeah, and it's hard to say. Sizable it's subjective.
Relative, yeah.
Yeah, so 1.9 million, sure, just depends what the premium is, and and so that and you're young and healthy, then yeah, you could end up with a pretty large death benefit, bigger than you would expect. But
yeah, my point being is that I wanted to I think, right, I'm going to have you review this soon, but I think I leveraged it for cash, but still I have this a death benefit more than I really need with other work policies. And so I guess I'm interested to see if it could be leveraged more, or if that's kind of the minimum when you go in, you get, X amount.
Yeah, and if you have a policy, the best thing you can do to review it, and you should do it every year, even if it's like the most plain guaranteed whatever, is get what's called an in-force illustration. So you call the insurance company or your agent, doesn't matter, and request what's called an in-force illustration. And then they'll ask you maybe like how you want it run. So you just as is, just whatever I'm doing, just show me that. And then that's when you can make, this might be easier to do with an agent, but that's where you can say like, funding for 10 years at current funding, or solve.
Is that only available after 1 year?
Yes.
Okay.
You already tried to get one?
Yeah.
Yeah. You got to hit your first policy a year before, because before the first year, you can just use the original.
Okay. Got it.
Has anyone here used their cash value for anything yet? Ryan or Steve, I think you guys have policies.
No.
Yeah, I've got a couple policies. I'm getting more. I've got 4 that are designed for the cash value. So I've got one on myself, one on my wife, and one on each of our 2 boys. So we've got, relatively young boys, 9 and 11, and we got them. Policies are now a little over 2 years old. So, I've been using them for cash. I don't have any loans out on it right now, but I've been using those policies for cash to get into syndications or as a down payment on our next deal. And so I've been using it with that same theory in mind. But also, when our boys are ready for college, I substituted funding 529s and put it into this policy. So now, whether or not they use that for college, we've got that flexibility. And now they've got a locked in premium for their life too. So they've got a head start on a policy premiums that are locked in forever. Probably won't be the death benefit that they need when they're older, but it's substantial compared to that right now. I also just in April funded, well, it was under a marketing term to your point earlier, but an IUL, which is indexed with the S&P, and so timing, I wouldn't have known it ahead of time, but the timing ended up being pretty good. But to your point about what you're using it for, that one is not going to be designed to use till I'm 65. That policy is specific for the death benefit and to have that as income in my retirement years. So I don't plan on touching that policy. That's premium that I put in that's going to be there for several years. And then I'm working on one right now, which is similar to the cash value, but most of my assets are tied in company stock right now. And when I leave the company that I'm with, that gets paid out over a 10-year note. So when I leave, I'm going to have a defined 10-year period that I get paid out on that note. So what I'm structuring now is a convertible term that when I leave employment and cash out that stock, I will then have the ability to hyperfund over 10 years, what will then be kind of an accelerated cash value life insurance policy. So I've got one designed for the future, one designed for future income, and then one for each of our family members right now that's designed for cash and utilizing it to get into syndications or new real estate. So that's kind of what we're using right now.
Yeah, nice. What I was thinking, that just to give everyone a practical example of how I look at this, and I haven't done it yet with a syndication, but the Western Wealth deals that Ryan are in, Steve's in, Sean's almost in, and I'm in. Those are, I think we talked about this a little bit, but they're trying to force equity and get your capital back as soon as possible. And so this is where I envision it would be a great way to use your cash value. You need 25 grand, you take it out of your cash value, you have a loan that it's at 5% simple interest. And so in year one, you're probably going to get 2 to 3% cash flow from the syndication, right? You're going to put 25 grand in, you're going to get 2 or 3%. So that won't pay back all of the interest, but you take that and pay back part of your loan, takes care of some of the interest. The next year, you're probably going to get 6-7%. So that'll probably take care of year 2 interest and most of year 1 leftover interest. So then you pay that back. Then, year 3, you're going to be able to pay back interest plus some principal. And by that time, you probably got some of the capital back because they refinance over 18 to 36 months. And then so you put some of that capital back and you just throw that back into the loan. And then your cash value policy may be built up again so you can use part of the paid back capital and part of a new life insurance loan and go out and do another syndication. Where if you didn't have the policy, you might have to wait until you got the second half of that capital back before you were ready to do your second deal. So it just, the whole point of Western Wealth Capital is this snowball, right? You're getting appreciation and a little bit of cash flow, and then as soon as they give you your capital back, you're doing it again. And so it's slowly building this snowball so that over time, if you're in enough of these deals, you're rolling off one, rolling in another one, and your capital is just growing and growing. Well, what the life insurance does, I think, and again, I haven't done it yet because I sold some stuff last year, so I have cash. So it doesn't make sense to get a loan when I have cash. But what I would be doing is just kind of allowing the life insurance to turbocharge my my syndications or my other investments. So that's kind of why I wanted Jameson to talk about this, is because it's just another tool to use to accelerate what you're doing. And these take a little bit of time to get to the point where they have the cash in, and there are ways to do it where you can dump a bunch in. I think that's what we were talking about. Brian was doing is you dump a bunch of cash in it right out of the gates, maybe, or somebody was doing that. But if you can't do that and you have to grow it, it might take 3-4 years, but then you can really help accelerate everything. So it's just one of the tools. You can also use your HELOC to do that in a very similar fashion, but the HELOC doesn't have any other benefits to come around with. And I've thought about doing that with the HELOC also. So anyone else have questions, comments on on life insurance?
I do, and actually, this might segue, Jim, into my follow-up on life settlements.
Yeah.
But Jameson, since you're kind of in this space, and you mentioned, there was one life insurance company not to go with. I imagine there's probably life settlement sponsors probably not to go with either. So any insight, I guess, from your perspective on, what to look for those kind of sponsors?
Not on the settlement side, Tom, only because I have one approved vendor because of my licensing. If I'm doing a settlement, it has to go through this one vendor. And so I've just, it's not something for better or for worse, I'm not as hands-on in that arena. I have a colleague who has done them more over the years. But actually, this particular person, I'm pretty sure they lost their securities license because they did one outside of an approved vendor like 20 years ago or something. So, So no, on the settlement side, I don't have any probably value or insight to add on that side. But yeah, I agree. I would research the hell out of probably the sponsor, and I can tell you which sponsor I use if you want to. But
okay, I may ping you afterwards.
So what, Tom, you want to use that segue and give us the follow-up and maybe
sure.
In a brief, 30 seconds to 1 minute, remind everybody who you talked to, and also for Ryan and Jeff?
Yeah, sure. So this was about a month or so back. I had a couple of calls. One was with Buck and his investing group, and then I had an individual one-on-one with, looking at my notes here, ASR Alternative Investments. They're the sponsor, Jameson, that I was kind of referring to, at least with this deal. And everything sounded great. So if you're not familiar, life settlement, though, is really kind of, as Jameson said, kind of a cashing out of a life insurance policy before the death benefit, just for the benefit of the policy holder. But where I got stuck last time, and I think where we ended up on the call last time, was I did a little bit more digging into one of the PPMs that they sent me on some of the previous deals they did. And what I found was, going back to 2011, they had raised, from 2011 to 2017, they had raised about $75 million of investments. And through the PPM, which, as I found out, was dated as of last year, so that gives you a little bit of a time frame that it was, still a year old, but they had only distributed about $14 to $15 million of that 74 to 75. And I was a little concerned because when I talked to them, their pitch was, well, think of it as kind of a 3 to 7 year investment time frame. Well, I went back to 2011. Well, that's a little longer than 3 to 7 years, and we're still only distributing 9% of the investment paid out over all those investments. So anyway, I had a follow-up call and got some clarification, and it seems like it's not quite the 3 to 7 years. It's more like 6 to 9 years. It's a much longer horizon, is what I got out of it. And that if you're willing to go more the long haul, as we talked about last time, this is definitely it's a guaranteed payout. It's just depending upon what kind of return you get based on obviously the purchase price. But that's really that's kind of my follow-up, Jim. Is
okay.
Just that it turned out it's more of a longer haul. And what ASR does is if some of these policies go more than 10 years, then they'll just package them up and then they'll sell it to other investors, and essentially then close that particular batch.
Okay.
But what they will do, and I think, Steve, this is a question you asked last time, was whenever a policyholder expires or they pass away, that's when the investors then see some kind of benefit. You don't have to wait until the very end of the deal. So you see it along the way. But again, what I've learned is that it's not a 3 to 7 time frame. It's more of a longer horizon time frame.
Ryan, is that were you with ASR?
Yeah, and I would say that I probably got in late 17, early 18, and we've had no expirations yet. I would say, and I don't know if this is true for everybody, but I've always thought of life settlements as kind of qualified money down the road. And this isn't anything that's going to generate any kind of returns for quite a while. So if you've got qualified money that's self-directed, this is kind of where I put that money in down the road. So I don't have any experience on payoff for life settlements yet, but I would say certainly that it's a long time horizon.
It's a long haul.
For any kind of
Yeah.
return.
And I was looking into doing this as well, and I kind of came to the end of the road because they couldn't figure out how to deal with my EQRP, which is going to bring us a great segue to the next conversation. But so I have I know James doesn't like the term EQRP. I have a self-directed 401k that owns an LLC that I am the trustee of, and that blew the mind of all of the people at the life settlements place. And then the guy who runs my EQRP, Damian Lupo, who's pretty good at the EQRP, he got on the phone and on the email and just berated the shit out of these guys, and they couldn't figure out how to make it work. And so because of that, if anything is with what I've learned, one thing I've learned with these syndications and other types of investments, if things are just getting intensely complicated, then I'm just going to back away and not do it. Because if it's so complicated that I can't understand even how to get the money in there, I'm not going to do it. And it doesn't mean that the company is a bad company, that it was ASR or whatever. It just means that they hadn't had an experience with my product, and Damien is a little bit of a bully, and he had no patience for them. And so he couldn't get it done. He's gotten everything else done as far as my EQRP and straightened everything out, but he had no patience for these guys. And I was like, you know what? If I'm not gonna, I don't want it that bad, right? I have other options. So I skipped out on it. If I could find an easy way to do it through my EQRP, I'd be all in. But so that's my story. Anything else on life settlements from anybody?
That's a nice thing about the life settlements is it's kind of a hedge because it's non-correlated, right? If the stock market crashes, people still die, right? So that's the nice thing about it. But yeah, I agree with Ryan that you should be putting them into qualified plans because you don't get any tax benefits, I think, right, from this. So it's kind of like you get, what'd you say, 12, 15% return, Tom, or what? Is that the returns you get?
That's about what they're talking about 12.
Yeah. So you can get that in a good real estate syndication with tax benefits. So I would definitely look at it for your IRA, self-directed IRA and that kind of thing. But beyond that, I don't know if I'm really that interested.
Yeah, makes sense. So moving on to more of Damian Lupo, Chad had a conversation with him about his M&M fund, which was super exciting sounding. But I think Chad, you can speak for yourself. Chad got some, didn't really like it. And separately, I talked to Buck and had he had a couple of one-word responses, and it's weird, but since then I have not heard Damien advertising on Buck's podcast anymore. So I'm not sure how far down that road that went. But Chad, you want to give us an overview of your call?
Yeah, I'll jump through real quick. So take for granted, this is the first call that I've been on, so I don't know what to compare it against as well, but I tried to take some notes and get a feel from a vibe from the conversation at the very least. So it's Damien, and then he's got a partner, David Morris, that is into the mini storage market, is his main focus. And they're starting this fund called M&M, which stands for Mini Storage and Precious Metals, which are two asset classes that are kind of interesting to me, which is what intrigued me about attending this and see what they were coming up with. But they're basically trying to raise $30 million into a fund and then start investing later this year as they get some money in the fund itself to use into mini storage, which would be your quicker return. They want to buy kind of a 80-20 split between mini storage and precious metals to kind of balance it out a little bit. It's a long term as well. Their return, they were estimating at about 10 years for it as well. Their marketing that Jameson wouldn't like is that this would be the last fund you ever need to invest in, which just seems a little over the top maybe as well.
I hate it.
Right, exactly. Exactly. So they walk through a bunch of, they don't have nothing purchased so far. So there's nothing in the deal. You're just, becoming part of the fund. It was $100,000 minimum investment as well. They're doing it as, accredited, but they'll take their 30 plus non-accrediteds as well. They're expecting the fund to triple in 20 years. So they want to get it from 30 million up to 90 million. And that's why they have this confidence that it's going to be very well funded for you as an investor over that time period as well. On the mini storage side, they're going to be focusing on secondary and tertiary investments. They don't want to get into building. They don't want to compete with the big guys, and they don't want to deal with the small mom and pop kind of situations. But their statistics that said 73% of the mini storage that's out there is owned by small businesses, and that's what they're going to focus on. So there's quite a bit out there to participate in, it sounded like. Their geography they're going to focus on is Arizona, Alabama, and Colorado. They've got a 12-member team, and they've got boots on the ground in all those areas. So they are going to be local to their own situation or their own team anyway. I think those were the big, their numbers they were predicting. Their IRR, they were expecting to be 10.8% after 20 years. And their cash on cash, they were expecting to be 11.1. With about a 7.8 times equity multiplier is what they were estimating. So they were taking small fees. They weren't trying to fee to death to start with. They were doing a sponsorship management fee of 2% and an acquisition fee of 1.5%, and that was it. But that was the gist of it. I didn't have a strong feel on it myself. It's too rich for what I wanted to invest in anyway right now, because I like the logic of smaller diversification, but I like the asset classes. I just don't know if this one was for me necessarily.
Yeah, I think this one was an interesting one because I like the asset classes also, and it was with a person who I, as Buck Joffrey always says, I know, like, and trust. Right? I mean, he set my QRP up. Well, I met him at Ryan. We were both there. He's an engaging speaker, a nice guy, and so and this is why building a network I think is helpful, because I got feedback from two different people that I know and trust that said, not for me. Chad, his first impressions were it wasn't for him. And I'll read you what Buck Joffrey said, because he has a Facebook group that Ryan and I are in, and I just asked if anyone had looked into it, and Buck responded and said, "There's no reason to trust he has any clue that he knows what he's doing. He's just trying to leverage his QRP list and pick up management fees. I'm a bit bothered by it, frankly. He will not be part of any future wealth formula event. There are other trust issues that have come up with him. That leads me to this conclusion. That said, I'm sure your QRP is set up fine. He needs to stay in his lane." So, Buck is either all in on a person, Western Wealth, or all out on a person. And I guess he's not all out on this person, but with this topic, so he has very strong opinions. So I don't know that this isn't going to be the right place, but I was kind of turned off when he said, when I started reading up on it, and he kept saying it's the last fund you'll ever own. That was enough for me to just be like, not for me. But Chad, I'm glad you made the call, and it was interesting. It sounds like, I don't know if have you read the book by Brian Burke yet, Hands Off Investor, that I showed you?
I'm 2 chapters into it right now.
Okay, because you were hitting the points where he's like, you got to look at the cash on cash, the IRR, the multiplier. And I thought, wow, this guy must have been plowed through the whole book. So you hit all the great points for your first call. So that's well done. Anyone else have any opinions or comments on this? I think we're moving past it. I mean, as far as investing, but anybody else have anything to say? No. All right, cool. We'll move to the Travis Watts call. I know there's about 4 of us that have that were on it. Who all, raise your hand if you called Travis after the last call. How about we'll start with Sean. You want to go over briefly what you thought of the call?
Sure. I thought, I got wind of the Woodland Key opportunity just prior to him joining us on the call. So I was scheduled and looking forward to talking to him about that opportunity in particular. So our call was probably, I don't know, half hour or so. And I'd say 2/3 of that call was structured around station regarding Woodland Key. The other portion was just him asking me about my strategy and things that I was looking for, and then myself likewise asking him about just some more in-depth questions that went beyond what he discussed with us on his call. And for both pieces of the conversation, I was impressed. I mean, I liked his background. It sounded like it was a very similar background to mine as far as starting, flipping and going to duplexes and single family, and then looking for more passive. So we lined up from a thought process very similarly. And then the Woodland Key opportunity, again, was something I was aware of prior to the call, and it just piqued my interest even more to get involved with that. So that's going to be coming this week, hopefully, as far as the PPM is concerned. But I liked what he had to say. I thought he seemed very sharp. And again, our backgrounds seem to be very similar. So I think that's always helpful. I mean, I can get into more actual details, but if you're just looking for a macro level synopsis, I'd say that's pretty much it.
Yeah, that's great. Was it Tom and Chad? When you guys, Tom, you want to have anything to add to that?
Yeah, just so I had actually talked with an Evan Pulowski back in early April about the Woodland Keys deal. And then when we had Travis on last time, I took the opportunity to follow up with him to talk more about it. And I agree with Sean, what you were saying. He's a sharp guy, really impressed. The other thing that I liked, at least about the deal, was when I talked originally to Evan, from that time to now, the whole COVID-19 thing has been happening. And, as a result, they went back and sharpened their pencils back with the previous owner on Woodland Key, and actually were able to get a reduction in the price and some better terms. So the deal looks like it's even better, although and again, this is all conversation that Travis had with me. It looks like what they're doing is they're trying to be still conservative on the returns, but still the purchase price has come down since they actually put this thing out to investors. But I thought it was a real positive conversation as well. He and I also talked about, he said, before he'd come up kind of through the single family into the more of the individual rentals. So we had Sean a similar conversation about that backgrounds. But he did also confirm that this deal typically, these guys do like a $50,000 for your first investment, and then you can go lower than afterwards. But he did confirm that for this deal, they're actually allowing first-time investors to start at $25K.
Yeah, and I think I'm definitely in for the 25. I was originally going to do 50 because they had two different share classes, and that kind of, I don't know, I'm like, oh, I better do two different share classes, right? Because I have shiny object syndrome like Ryan and Steve sometimes do. But I talked to Sean, and he had, of course, dug into the numbers as Sean likes to do, and it doesn't make any sense to do that. So that one class is the A shares, you get 10%. Always, no upside. So when they sell, you don't get any upside, but you get guaranteed 10%. I need cash flow. I like cash flow. I don't have a W-2, so I was all in on that. The other one, I think it's 7 or 8, but it escalates, and by year 3, they estimate you're going to be at 10%. So when you're thinking about a $25,000 investment, it makes no sense to go for the A share. So I call them back, and I'm just going for $25K in the B share. I probably would have done 50, but I'm trying not to do too much during the COVID. I don't want to stop, but if a deal's a good deal and it's going to cash flow, I don't want to stop investing, but I also don't want to do more than I have to. Chad, you said you talked to them also, correct?
Yeah, I did. I took a little different spin with him. Again, I'll echo the comments. I thought he was great to listen to and great to talk to on the phone. I approached him more picking his brain from a non-accredited standpoint. For us newer folks, I'm not accredited, just to get advice, and he was very forthcoming and kind of pointed out something I probably should have picked up on by now, but I was trying to stress on how do I discover these. He's like, well, you can look at about any investment, because even the 506Bs, they're offering some non-accrediteds on each of those deals. So don't shy away from those. Look into them as well, and you might be able to go in as one of the non-accrediteds on those too. He also, gave me, which I think I've heard it from others as well, but he said, really take time to figure out your focus of, are you looking for equity, looking for cash flow, and try to stick to those deals so that you are focusing on your longer goals that you have. And then he was nice enough. He sent me a bunch of names of funds to talk to reach out to that he knew were taking non-accredited still as well. So I probably should publish that out to the group so you guys can see.
Yeah. If you can share that either through email or on Slack, I should put Slack on the agenda at some point. I'd like to start, using that more, but if you could share that, that would be fantastic. I'd really be curious about that.
I'll put it out on Slack tonight. So
okay.
Michael Blanc was on there, which I know we've talked about with Nighthawk before. I can't remember the other ones, but I specifically asked him about Nighthawk a little bit too.
Okay. Yeah, what I talked to him about wasn't this deal. I talked to him about basically just passive investing, and he gave me the top 5 that he is investing in, the top 5 sponsors. And one was Monarch, which I had heard about from Steve. I contacted them. They're not taking any new investors. They just don't need anybody else. So they're closed. They're not even interested. Another one was Real Asset Investors, which is Zook. I don't know if some of you know him. I'm in with him on ATM machines and Reliant. The next one is Reliant Self Storage, which I am in. So that self storage through Zook. I think, Steve, are you in that also?
Yeah.
Yeah. So those are the 3, and then I told you he said on our call last time that he doesn't like funds, but he's in two fund groups, and they're not multifamily, a little bit different. One is the PPR Note Company, which is a note fund, which the guy wrote a book, a Bigger Pockets book. I forget his name, but I'm
Dave Van Horn.
Yeah, thank you, Dave Van Horn. So I'm looking into that one, and then the other one is Pikes Peak. Has anyone heard of Pikes Peak? They buy distressed single-family homes, they fix them up, and then they rent them in a rent-to-own style to low-income or low-credit families. So it's kind of a social benefit money-making deal, which really sounds interesting to me. And they have a new fund coming out next week, and I'm going to be getting an email on that. So if people are interested, I'll share that when I get it. So that's what I got out of it. Anybody else have anything on Travis?
Yeah, I'm coming away from a total other direction, but after you and I talked last time, Jim, the name Travis sounded familiar, and who's he with right now?
Joe Fairless. I mean, he's
okay.
with Ashcroft.
Ashcroft.
Okay. I talked to Travis probably almost 3 years ago now, 3 or 4 years ago. And he was at the time with a group called Direct Source Wealth. And the conversations you guys are describing is exactly the guy that I talked to. I mean, very engaging, smart guy. And I only bring this up because apparently if he's not with them now, he had left them. And I never invested with Direct Source Wealth after I talked to Travis, but he apparently isn't with them anymore. And when I looked him up a couple of years ago, it just seemed a little hokey, and so I never dug into him anymore. And so I asked that for if anybody talks to him again, he might be a really good resource for why he left a certain sponsor, and why he feels like Joe Fairless or the other ones that he's doing or working with, how he's vetted them and what he asked. So I think he'd be a really good resource. I haven't talked to him since then, but just knowing that he's been with another syndicator, a large syndicator years ago, he might have a really good perspective if he's willing to talk about past employment. So.
Actually, I'm an investor with Direct Source Wealth, Brian. And I knew Travis from then too. So I asked him that question, and Kira, who is the CEO of the group, moved all her operations down to Puerto Rico to take advantage of all the tax laws down there. and
Okay.
they wanted him to move down to Puerto Rico. Of course, he's in Denver, I think, so he did not want to do that. He didn't badmouth them or anything. So, I mean, I've always had good conversations with Kira, and now she kind of does a hodgepodge of things too, and then maybe that's what he wasn't liking. I think he's a big multifamily guy, so that's probably part of it. So I think that's my take on it. But again, he didn't badmouth anybody in that conversation. So
No, that's good to know. And I think at the time that I looked into them, from when I first did, they were moving everything to Puerto Rico kind of out of the blue, and they were starting other more diversified, just general funds. And so that's when I just wasn't sure what they were doing. So I shouldn't say that they were doing anything wrong. I just wondered why he transitioned, and thought that'd be a good representation for what he has learned and how he operates with different syndicators. So that's good feedback and good to know.
And
I didn't know anything about it when I was talking with him. I didn't think anything of it because I didn't know his background. But to listen to you, Steve and Ryan talk, he did make mention of a past syndicator that he was with, and comparing it to Ashcroft, and the fact that the reason why he really liked Ashcroft is because they stay in their lane, and it's a lane that he's familiar with in multifamily. He made that comment in our conversation, but again, it didn't resonate with me because I didn't know his background. But hearing you guys talk now it makes sense why he said that.
And Jeff, if you're in Denver, it might make sense if you give him a call, because he has access to a group similar to ours, except it's got like 300 or 400 people in it.
Okay.
And it's run by this one guy who, lets people he has sponsors come and speak to his group. And if you're not on his good list, he's not going to let you speak. But it's a meetup that I think Travis goes to. So if you're local to him, that might be something where you could find some other sponsors and hook up with them that way. If you were to do just an intro call and mention you're in Denver and affiliated with our group, that might get you in there if they ever start doing their meetings again.
That'd be great.
Yeah. All right. So we're past an hour. Since we're having next time, Matt Cheney is talking. I was going to see if Mike, if you wouldn't give us a 3 or 4 minute overview of your call with him, and because I don't want to do that next time since he's going to be on the call with us. That'll give everyone kind of a preview, and then I have Praxis that I'd like to talk about, but I'm going to table that to the next time because I took 4 pages of notes from this guy. I thought it was awesome, and I'm investing with them. Their next deal that comes up, they have a pretty cool thing where you can park your money in in kind of a debt fund, and they pay you 6%, and you got to stay in there for a year unless you transfer that money directly to one of their syndication deals. And it's $100,000 minimums, but $50,000 for the first deal, so it's probably bigger than some people want to take out on the first time. But they've been in it since 2002. I was super impressed by them. So I'd like to share that, and I'll just hold that to next time and let Mike talk about Matt for a few minutes, and then we'll close up. I apologize, we went a little bit long, but it seems like everyone's chatting. So go ahead, Mike.
Yeah. So I actually got introduced to Matt through Steve, and I like Matt. He really down to earth guy and seemed to be take very hands-on approach. And something I didn't even ask, which I should now know, having learned from you guys a little bit here, is I should have asked him more about his overall team. But Steve probably could speak. Steve has a longer history with Matt as far as how his team's set up. But it really seems like he kind of runs it like a one-person show from how he talks about it. Anyway, seems to be very intimately involved with his business. He did say that for his deals that he's taking 20% right at the beginning, right off the front, which it sounds like, talking to some other sponsors that it kind of varies across, how they vest those shares, and what sort of buy-in sponsors have in their deals up front. But overall, it seems like he's a pretty conservative guy doing maybe 1 or 2 deals a year. And I know that they've got some. Steve, are you guys are they listing that property that you just invested in like what 2 years ago?
Yeah, so I invested in this property in Lawrence, Kansas, which is where the University of Kansas is located. And so they are now, I think this week or next week, they're supposed to be listing it. So we'll see what happens with it. But he was saying that we may be able to get the 5-year return in 2 years. So let's just, I'm not complaining.
Nice. Yeah, nice.
So, but in terms of the team, yeah, Matt is kind of a one-man show in a way, but he has a partner, Justin Martinez, who is more experienced than he is. They are both students of Brad Sumrock, and they went through his program. And so they have Brad, who has a lot of multifamily experience, go through any deals that they're looking at seriously. He'll run the numbers himself and look at it. So he's got the master, if you will, kind of overseeing the deal as well with them. So, but yeah, he's conservative. He, from what I've known him, I think he's only done 2 offers. I believe that 2 deals. I think he did another one in Lawrence, Kansas, and at the time I wasn't liquid, so I couldn't invest in it. But yeah, they're a really good guy. You'll when he talks in 2 weeks, he's very receptive to questions. I mean, I've been on the phone with him hour and a half at a time, several times. I mean, it's just a really, really nice guy, and hopefully you guys can eventually do deals with him too.
Yeah, he did mention that about 75% of his holdings are through Brad, and 25 are his own generated. So
yeah, he does a lot of passive investing too, I believe. So we'll have to ask him about that.
Yeah,
and he's really conservative in the conversations I've had with him, which and he's so open and authentic that he's the kind of guy I think that you underwrite him as the sponsor, and I don't know that I would put a whole lot of extra or need to put a whole lot of extra due diligence in a deal that came across from him because knowing that he knows Steve and he knows and that I've met him in person. I'd feel comfortable with him just from what he knows what he's doing. He's so conservative. He's only done 2 deals. A lot of those guys from Brad Sumrock's group come out, guns blazing and are in all kinds of deals. So it was your overall good impression, Mike? Yeah,
really, really was. I'm excited to see what, hopefully he said, whenever I talked to him, he said he was looking at a couple deals that he didn't know if they were going to be come to fruition or not, but the quick glance, they look pretty decent. So
he's actually interested in the Columbus market too. So that'll be interesting if he ever comes up with something here.
Yeah. He offered to speak at the coin meeting before the COVID got in the way. He was going to come out here in June or July and speak to our monthly meetup, the larger one. But that's not happening now. So, all right. Well, thanks, Mike. So, like I said, I think I'll postpone the praxis, and Joe's not here today. He offered to talk about the perspective of a syndicator because he's actually doing syndications. Thanks, Sean. Sean just commented to me that Bernie Madoff was endearing too. So that tells you that right there tells you the difference between me and Sean. I'm ready to go when I trust somebody, and Sean's ready to look under the hood a little bit more, which is why Sean and I make a good partnership sometimes to bounce things off of. But Sean finally pulled the trigger on a guy he doesn't even know in California. So, Sean's got nothing to say. That was funny. But any last comments or questions? All right, so next time it'll be 2 weeks from tonight, I believe, and Matt will be here with us. And probably we won't do, if we get done with Matt, we might add 1 or 2 other things on it. But I'm trying to keep these to an hour and 15 minutes because we're doing them more often. So hopefully that's cool with everybody. If you have information that you'd like to share, you can try the Slack, or you can just email it to the group. I think it'd be great if you get solicitations from sponsors or deals from sponsors. Just forward it to the group. The more information we can share and have people look at, the better. If people get sick of getting emails, if there's too many going around, we can adjust. But I'd like to see what people are into, and that way we can all figure out what we want to do and what we can work out what sponsors are best. And we're going to come up with this calculator. Hopefully that'll help us, and then we can really start working together to get some investing going.
Hey, Jim.
So, yeah, Jameson.
I just thought of one thing, and I guess if this applies to anyone, feel free to just message me, or I can send some information if you're interested. But I was just going to add to the life insurance piece. Some of you have taken advantage. There's stuff you can do, but you can also go to another level and actually finance those premiums, finance the money that goes into the policy. I see Ryan shaking his head. That's called premium finance. You can Google it. Basically, it's the same strategy, except instead of you putting your money in, you let a bank do it for you. But you need to be at like $5 to $10 million of net worth for that to even probably make sense. So if that applies to someone and you want more information, let me know. I meant to just bring it up, but I forgot about it.
Cool. Thanks. Anyone else? Last comments?
Jim, I was going to mention real quick, I threw out on Slack, I found a due diligence list for vetting sponsors from another mastermind group that I'm with and so forth that I dumped out there to a couple pagers, just if it's worth anything to anybody, FYI.
Awesome.
Yeah.
Hey, yeah, Mike, I don't know how familiar you are with Slack, but since you set it up, you're in charge. When someone posts something to Slack, do we all get notified?
You should. And if you have the app on your phone, it should send you a push notification as well.
Okay, because I haven't gotten anything. I don't have it on my phone, but I just do it on my computer. I've been posting stuff, so I didn't know if anyone else got anything. But when Chad posted anything, I didn't get an email. So should we check and make sure we're set up for notifications?
Yeah, let me log in really. Well, I can check after here and email you guys.
Okay, yeah, just let us know if there's a setting we need to do to get notifications, because I haven't been getting anything, and I'm trying to post agendas up there. I'm posting the recordings up there, and so just let us know what we have to do to get notifications. If there's other old folks like me, we probably will do it on a computer rather than on our phone. Looking at Sean for that. So if you can let us know how to get notifications on our emails, that'd be great.
Yeah, sure. Yeah, I'm getting your notifications whenever you're posting stuff. So I'll see if there's something setting I have set up.
All right. Go ahead, Sean. What are you going to say? Bring it on.
Oh, I was just going to jump in and thank Jameson for taking care of my life insurance, because I had one shitty insurance agent before that. For those of you that don't know, that was Jim.
Nice.
Yeah. Jameson's much better hands, or Sean and I are in much better hands now that Jameson's handling our stuff. Thank you, Sean. All right. Well,
Sure.
Thank you, everybody. This was great. I appreciate all your contributions. And, the one thing that I'm really liking about this group is that everyone's contributing and going out and doing these calls, so they have something to share on these meetings. And man, that makes a huge, huge difference. And maybe sometime before the end of the year, those of us that are local will be able to have a beer together. But until then, I'm enjoying these meetings. They're helpful to me, and I hope they're helpful to you. And let's just keep communicating, and we'll see you in a couple of weeks.
Sounds good.
Thanks,
Thanks,
guys.
Jim.
Thanks
everyone.
guys. Take care. We'll see you.